And if that's the long-term vision, there's no reason that you're going to end it at 10 years. And so this is not even applicable, is what I was saying, right? This, so is that making sense, Dan? Or you want to add or edit that at all?
Yeah, I think you write a 10-year note, and at year 9.5, you go, man, this is going so great for me. I got this passive cash flow. $10 million at 10% is going to kick off $1 million a year after year after year, and you're taking whatever part of that you want. And yeah, you pay income tax on that interest income you receive, but you don't have to take it all. So it's more than the 10 million compounding. Now maybe you don't take any year one, and now you got 11 million. And then year two, you got 12.1 million. And it's just compounding and growing, and you're taking what you want and you're paying the tax. You get to year 10 and you're like, I want to keep this gravy train going. Like, why would I want to unwind it now? I didn't want to pay the capital gains tax then. I don't want to pay it now. I'd rather defer it. And so you go back to the tax attorney and amend the note and kick it out another 10 years and another 10 years. And if something happens to you and your spouse, your kids or your heirs can step directly into your shoes and they can continue the deferral. I think the biggest risk is that the kids who didn't put the blood, sweat, and tears in to realize how difficult it was to earn this money just go, I don't want to deal with the trustee.
Hello, everybody. Welcome to another short episode of the Capital Gains Tax Solutions podcast. I'm Brett Swarts, and we're talking about all things capital gains tax solutions, using mostly trust to exit highly appreciated assets, along with installment sale reporting or annuity reporting to eliminate some estate tax, defer some capital gains tax, just really depending on what you're trying to achieve. Hey, Dan, one of the deals we're working on, and one of the objections we get sometimes is along the lines of, hey, who gets the upside in case this trust outperforms? You kind of want to tee it up on the question that maybe gets asked, and then we can kind of walk through it for people.
Yeah, we have some people that ask this question. First of all, I'm Dan Palmer. Brett didn't introduce me.
Oh, sorry.
I'm on the team.
I figured you know because we've been on so many calls together.
But yeah, so normally the promissory notes for a period of time. It's flexible. It can be 3 years. It can be 5 years. It can be 10 years. We normally write them at 10 years. And if we succeed at all the investment strategy that we put together and we exceed the interest rate on the note over the full 10 years, then the interest that has accrued that's over what the promissory lists goes to the trustee. And so there's a couple solutions for that. First of all, I would just point out, if that happens, it means everything went according to plan. Everything that we hoped would happen with the investments worked out perfectly. And we're normally pretty aggressive with that interest rate note at the beginning because we do want all the funds to go to the client initially, of course. So we're already aggressive, and if we hit that, it means we knocked it out of the park for 10 years and they got all of it. So if there's extra, that's actually not a bad thing. That's normally a good thing. But there's some other opportunities to deal with it also.
Let me define this a little bit better. And that's, you said exactly right, Dan, and make it really clear what we're saying here. Let's imagine it's a $10 million note, and let's imagine we wrote a 9% interest rate on that note. That 9% is a compounding rate net of fees. Net of fees, okay? So that's what's owed to you. So what Dan is saying is that's pretty good, right? To hit 9% compounding on 10 million net of fees is not an easy feat on any 10-year period of time. Things can go higher, could go lower, but that's a pretty good return. Now, what's the alternative? I think it's always important to point out that you would probably pay 20, 30, 40, or 50% of that 10 million up front in tax had you not used the service, right? And so you have to be looking at this really clear and figure out how tax painful is that 20, 30, 40, 50% of your net worth on the sale of your business, of your real estate or other asset. Second is, and we talk about making the DST an investment and not an expense, it's not just that initial 20, 30, 40, 50% more, it's the ongoing income tax deferral, which is probably the most powerful. Dan, you want to break that down real fast before we talk about some of the solutions on how someone can still get the upside above and beyond the if properly structured, above and beyond the interest rate?
Yeah, so reframe that question again.
Yeah, so the importance of income tax deferral. In other words, how do you make the DST an investment and not an expense, right? If some people think, well, I'm just going to defer, 2, 3, 4, 5 million on my 10 million. It's just that, although that's a big number. Yeah. But the additional, 10 million making 9%, 900,000. How is that? And if I'm not taking that for a couple of years or just taking portions of that, the income tax deferral?
Well, I mean, we're both originally from California. We're in low tax states now, but we grew up in a very high tax state. That's our background. So if you had a $10 million exit in California, you're going to pay 30 to 40% of that in capital gains tax. So you're going to lose $3 to $4 million right off the top. So that's the first loss. With the deferred sales trust, you have the full 10 million working for you. So if you just pay the tax, you've lost that 3 to 4 million right off the top, but you also lose the compounding nature of that 3 to 4 million. At 10%, 4 million is going to kick off $400,000 a year indeterminately if it's within the trust and it's deferred and it's compounding and growing in your interest. So when we say make it an investment, not an expense, we're talking about the compounding nature of holding on to your money longer. It's still the government's money. You still owe it. You're still going to pay it sometime way down in the future, maybe your kids, maybe their kids, as you defer it over a period of time. But you keep the original tax that you would have paid, and you keep the compounding nature of that. And it's hard to explain it to people if they can't see the numbers on paper, but the numbers are eye-opening when people realize how their wealth can compound over time if they can hold on to that tax and have it be invested and grow in their favor.
Okay, so that's huge, okay? Plus you get asset protection, okay, so against creditors. Plus you get the ability to diversify, partner with the trust, be an entrepreneur or be retired, all of those things. But now we really want to focus on what we were talking about before. Like, how does this work? Like, does the trustee just get all the upside at the end of the term? Well, here's the reality, Dan. Most people will renew the term every 10 years for 10 years. So let's talk about when does the end of the term? You just mentioned a second ago, the kids renewing and going to the kids and they're renewing. Guess what? You can keep renewing. And so there's, the question is, will it be an end of a term? Now, technically, if you did it for just 10 years or a 5-year term or whatever it might be, and if you ended it at the end of the term and there was excess remaining above and beyond the promissory note net of fees, then yes, the trustee on one of our versions, legally, we are required to take the upside. That's part of our business purpose. That's part of what keeps the compliance on this. So, but the reality is most people, we have found, are going to want to and have renewed the note at the end of the terms, and therefore it's not ending, okay? And so think big picture here. You want to start with clarity, like why are you setting this thing up? Well, most people want passive cash flow. They want diversification. They want the ability to do deals with themselves or partners or kids or grandkids. They want the ability to eliminate some estate tax. Those are just some of the common things, but a lot of them look at it as like a wealth building machine, meaning it is a trust here that is paying us cash flow that is 20, 30, 40, 50,000 a month or more. And that is what's creating the freedom of time and energy and having to have a business or real estate. So if that's the concept, and also to fund charitable causes or fund things that you believe in to make an impact, and if that's a long-term vision, there's no reason that you're going to end it at the 10 years. And so this is not even applicable, is what we're saying, right? So is that making sense, Dan? Or you want to add or edit that at all?
Yeah, I think you write a 10-year note, and at year 9.5, you go, man, this is going so great for me. I got this passive cash flow. $10 million at 10% is going to kick off $1 million a year after year after year, and you're taking whatever part of that you want. And yeah, you pay income tax on that interest income you receive, but you don't have to take it all. So it's more than the 10 million compounding. Now maybe you don't take any year one, and now you got 11 million. And then year 2, you got 12.1 million. And it's just compounding and growing, and you're taking what you want and you're paying the tax. You get to year 10 and you're like, I want to keep this gravy train going. Like, why would I want to unwind it now? I didn't want to pay the capital gains tax then. I don't want to pay it now. I'd rather defer it. And so you go back to the tax attorney and amend the note and kick it out another 10 years and another 10 years. And if something happens to you and your spouse, your kids or your heirs can step directly into your shoes and they can continue the deferral. I think the biggest risk is that the kids who didn't put the blood, sweat, and tears in to realize how difficult it was to earn this money just go, I don't want to deal with the trustee. I don't want to deal with the tax attorney. Just pay the tax and give me what's left, because they didn't earn it. And the parents are rolling over in their grave because they know how hard it was to earn that money and what they put into it. But it can really be generational deferral if it's done right. And with the compounding nature of it, when you see the numbers laid out on paper, oh my goodness, it is incredible.
So let's be really clear on this. We'll do a couple scenarios. I'm gonna do one scenario where you actually ended at 10 years and we outperformed. I'm gonna do another scenario where you just renew. So I'm gonna start with the renew one, like what Dan was talking about. So on the renew one, right, in that scenario, by the way, we do want to take some payments starting about year 3, right? At least half the interest is kind of like our internal or kind of the tax recommendation from the tax attorneys to take some payments. And so it's not something where you're just compounding it for 10 years, not taking any payments. You're taking some, but that being said, it doesn't have to be the full interest on that payment. But let's just fast forward in 10 years, and let's just say, you had 10% it was owed to you, right? And let's just say, Dan, that so the 10 million is due plus 10%, which is $1 million a year. So that's basically $20 million. So let's imagine it performed perfectly plus additional $1 million, okay? So there was 20 total in there, plus another $1 million that was excess. So the 20 is owed to you, okay? And you've been taking that 10 million over that period of time, and it comes to the very end, you're like, oh my gosh, like the thing is a total return of 21 million, but oh man, I only get the 20, I'm ending it right now. Yes, technically the trustee would get that $1 million, okay? And you would just get your 20 back and you pay your tax on what you received, and obviously you received your balloon payment at that point, so then you pay the capital gains tax on that. So that's scenario 1. Now do a scenario 2. It has $21 million in there, right, total. And you've taken that over some time, but that's the total return. Whatever's left over, there's an excess of $1 million. You can then, the note can be amended or refinanced for another new term. And that new term includes that other $1 million, okay? So trustee doesn't take that $1 million. And in fact, that kind of gives you a hedge for that next 10-year term or 5-year term or whatever you want to make it. And that, in fact, we might, depending on the interest rates, negotiate a little bit higher interest rate at that point, knowing that we have a little excess to catch up on over a period of time. In other words, Dan, if a tree falls in a forest and no one is around to make it to make it sound, does it make it sound, right? This is a philosophical question, but if the trustee is not actually getting the upside, even though he could get the upside if it was actually closed, but we're just extending it for a longer period of time, is this actually an objection, right? Or is this something that, folks are, need to be aware of course, make sure you understand these things. And then I'm going to go into the 2.0 version in a second. Go ahead.
Let me just summarize what you're saying.
Okay.
So the only way the trustee gets the $1 million is if you unwind the trust and pay it out.
Correct.
But who wants to do that?
Right.
And so all of our clients at year 9.5 are going to say, I don't want to unwind the trust, because I'm going to pay the tax when I unwind it. I want to amend it and kick it out another 10 years. Well, the trustee having excess also gets kicked out. You raise the interest rate, say the interest rate was at 10, and you go, whoa, we did so well over a 10-year span that we got everything that we were hoping for and more. Well, let's raise the rate to 12 for the next 10 years. And you eat into that $1 million, and by the end of the next 10 year, you're even again. The goal of the trust is to be even. The goal of the trust is to be commercially reasonable, but also to actually succeed in the investments. It's crazy to me. People are like, hey, I would rather it be under and you get nothing than for it to actually meet it and me to get everything I hope for and you to get extra. If it goes under and the trustee gets nothing, it means the investments were below what we hoped for. That's a worse outcome. But it's funny how people are with money. It's funny how they think about it. But in reality, going above is the best case scenario, and then you amend the note and you can use that as a buffer zone to take it over the next 10.
Everybody wins. And by the way, we didn't make these rules in the tax code. We just follow them, right? So this is just part of the tax code. This is part of why the audits have been successful, because we're not going to sugarcoat what is or not going to happen. And we have some creative ways to mitigate potential upside, which we just talked about one of them, to renew the note. We'll talk about the second one, Dan. So the reality is a lot of the investments are going to be diversified. And generally speaking, if you're working with a balanced portfolio of, stocks, bonds, mutual funds, that kind of thing, it's an 8 to 12% range over any 10-year period of time, depending on some of the risk tolerance. There could be a little bit lower, it could be a little bit higher. Now, if you go to private equity or go into other real estate deals of your own or businesses, guess what we do? We do a joint venture partnership with the trust, right? For that amount, and that amount is set at typically an 80-20 with a preferred return back to the trust, and the ability to purchase an option for upside. So breaking it down, 10 million goes into the trust, and you're like, hey, I got this amazing $3 million real estate opportunity. I'd like to, build this property or buy this asset and improve it. And $3 million can go into an LLC with you as the managing member, you being the client or the note holder at this point. And the trust is partnering with you to purchase that. And so let's say that $3 million turns into $6 million over a period of time. The trust gets its $3 million back plus a preferred return. And then you would get 80% of the upside, okay? And if you purchase an option, you can get up to 98% of the upside. And so in other words, there's mechanisms to, when we think that the investment portfolio or the asset allocation, if there's certain amounts that we think are gonna go above and beyond, let's say the general 9 to 10% interest rate, there's ways to do this. And so a lot of times this is the entrepreneur who's thinking like, gosh, like I don't want to, lose out on this upside. I just built this company to, 10, 20, 30, $100 million. I can't imagine, 10% is kind of maybe too conservative for them. And well, this is how we solve it. You're not capped at that 10% if you just joint venture partner and go build a business, go do a real estate deal, do some investment outside. That's so important to understand. Some guardrails on this, okay? So this is not something where you can like go day trade with that investment, okay? We do have to have like kind of a specific investment. You might go into a real estate deal that you can build on your own or with a business partner or with a group. Like there's some other guardrails that we kind of be aware of, but usually when we explain that to people, they realize, oh, I'm not in a box, I'm not capped. Got it. I'd like to continue on this, and in this one particular hypothetical situation where if I were to get out at 10 years and it were to outperform and it were to do all these things and it's excess, yeah, okay, I get that. But if I renew, now that's off the table. Let's move to the 2.0 version, okay? There's a 2.0 version that's really reserved for 10, 20, $100 million plus deals. It's mainly an estate tax elimination play, which is great. No charity life insurance gifting required, no seasoning required. Again, any asset of any kind for what we're talking about here. It can be Bitcoin, it can be stock, it can be real estate, it can be business sales, it can be primary home, luxury real estate. But on the sale, we are eliminating the estate tax and we're making the kids the beneficiaries of an irrevocable trust. Now, here's the reality. What's beautiful about this is that upon your death, and if you're married, your spouse's death, the kids inherit all of the upside, no matter what the value is of the trust at that point, estate tax-free and capital gains tax-free. The downside is, during your lifetime, you're paying more tax because you're gonna have to take principal and interest back. And the payment back on this, the way that it's structured, is not as flexible as the other version that we were talking about. But if your big problem is like, I don't wanna have to think about renewing, I don't wanna have to think about joint venture partnerships, I don't want to think about anything. Great, well, let's just go straight to the 2.0 version. Let's just, and if you're okay with your kids getting all of the upside, let's make your kids the beneficiaries. And if the thing returns 150% on average, over all the term, and it outperforms, there is no ability for the trustee to get the upside. And so that is the key, right? I want to encourage any of you who are listening or watching this and considering using our services is that you may have advisors who think they know about what we do and how we do it, but they've never actually done it. And oftentimes they take one little piece that in one way could be perceived as a negative or a downside for you. They don't have a solution or creative way around it because they've just never done it before. And we want to encourage you to bring that person on with us to help us walk through what we just walked through with you, or share this video with them and give them an opportunity to discuss what this actually looks like practically. Dan, anything last thoughts you want to add to this?
Yeah, I think it's a mood issue once you actually get into the numbers. And I think that's the hard part when you're looking at it from a distance and you don't really understand. You're like, the trustee gets some of the up, and you don't realize that even that situation is a giant win, and then it gets mitigated when you amend the note, but you're winning. Yeah. And that's why we connect people with our clients before they close their deal. We say, hey, talk to someone who's 5 years ahead of you, 3 years ahead of you, 10 years ahead of you, and hear their story about how it works for them. And most of these people have 1031 over and over and over again, and then they find the Deferred Sales Trust and they're like, why didn't I know about this earlier? And so we make that connection because it's hard to understand it until you're in. But once you're in, you realize the power of compound interest and what the Deferred Sales Trust does in terms of your ability to grow your wealth over time, and also to have it become a passive cash flow machine for your life. And so, those conversations I think are really helpful also, Brett.
Awesome. Dan Palmer. He's Dan Palmer. I'm Brett Swarts. I want to encourage you to take action today. If you're an advisor out there and you have a client who has large exits, $1 million and above in net proceeds and gain, they want to reach out to us at capitalgainstaxsolutions.com. So CPA, M&A advisors, business broker, real estate agents, financial advisors. As well, if you're a client and you're considering using our services, also please reach out to us. We have a book you can check out on Amazon, Building a Capital Gains Tax Exit Plan. It's kind of my story from really selling and helping people buy investment real estate to figuring out ways to solve big tax problems such as capital gains tax and estate tax. Check it out on Amazon, Building a Capital Gains Tax Exit Plan, or just go to capitalgainstaxsolutions.com. We have a YouTube channel and a podcast as well. If you haven't subscribed to that, check that out. We so appreciate you listening or watching out there and are considering hiring us to work with us to provide services for you and your family. And we'll talk to you real soon. Bye now.